Ever felt like the market is out to get you, hitting your stop losses before moving in your anticipated direction? It's not paranoia, it's a tactic known as a liquidity grab. In this video, we'll uncover how institutional traders exploit these moves and how you can turn the table in your favor. A liquidity grab occurs when large market players push prices to trigger clusters of stop loss orders, creating the liquidity they need to execute substantial trades. These moves often manifest as sudden spikes or drops, luring retail traders into false breakouts or triggering their stop losses, only for the market to reverse shortly after. The primary goal is to capitalize on the liquidity provided by the retail traders' stop orders, facilitating large position entries or exits without significant slippage. Identifying liquidity zones. Key areas. Look for zones where stop loss orders are likely aggregated, just above resistance levels, below support levels, or around recent swing highs and swing lows. These areas often precede sharp price movements, as triggering cluster stop orders injects volatility and volume into the market. Trading strategies. Post liquidity grab. Wait for the price to re-enter the previous range or show sign of rejection from the liquidity zone before considering entry. Entry points. Utilize candlesticks patterns like pin bars or engulfing candles as entry signals after a suspected liquidity grab. Risk management. Place stop loss orders beyond the extreme of the liquidity grab to avoid being caught in another potential sweep. Profit targets. Aim for the opposite side of the established range or the next significant support resistance level. Real world examples. Here is a daily chart of silver USD, and as you can see from this chart, we are clearly in an uptrend. And here we have a resistance here which was taken out by another resistance here. But if you look at this carefully, if you are a price action trader, you could see that we have an engulfing candle here and price rallied up, set a new resistance. And after that, we can see these bearish candles. You could look at this as a price action trader and say this could be a beginning of a new reversal, judging by the candles you are seeing here. So, as such, a price action trader can decide to place his entry right here, his stop loss right above this resistance, and he can decide to target this last support here as his target level. Now, you look at this and tell me, is there anything wrong with this setup? The answer is simply no. But one thing with this kind of setup is that we are not trading alone. There are other players like institutional traders who are also in this kind of trade. So if institutional traders are to come into this trade, this is what they would do. You see this candle? They come and they trip off all the stop loss placed around this zone. Those using tight stop loss, that will place it right here, and those that will give a bit of a room, they come and they trip off all the stop loss. Immediately the stop loss are triggered, the next thing, boom. You see, a bearish candle. Price is now finally heading in the direction the retail traders expected it to go. Institutional traders do this for them to have enough liquidity to place their trade. So, this is what happens most times when you place a trade. Sometimes you think if the market is out to get you. No, it's not. It's the institutional traders that are manipulating the market in their own favor. So when you are trading, you also watch out for the possibility of institutional traders coming into play. And if you see this kind of wick before entering your trade, it's a good sign that the manipulation might be over and price might head in your direction. Here is the bearish example. We have these three white soldiers. If we place our entry here, our stop loss here, then our target right around this zone, it should be a good sign for us, but it is not always that way. Now, with our entry here and our stop loss here, let's look at what happens. You see, immediately after entering this trade, price reversed, and see what happened. This is what happened. Let me place this stop loss very well. So price reversed and we have this spike, which at this point would have cleared up the stop loss around this zone. And after that, you can see price started going in the intended direction. This is how institutional traders manipulate the market. Not every spike or dip is a liquidity grab. Avoid jumping into trades without confirmation. Always consider the broader market structure and trend before acting on a potential liquidity grabs. Ensure proper stop loss placement and position sizing to protect against unexpected market moves. Understanding liquidity grabs can transform your trading approach, turning traps into opportunities. If you found this video insightful, give it a thumbs up, subscribe to FS page for more trading strategies, and join our free Telegram channel for real-time updates and discussions. Share your experience with liquidity grabs in the comment below.